this is John Kvale, and this is our video podcast review of the Q4 2018 newsletter. This is the last one of the year, and so what we like to do for newbies is we like to add a little granularity to what we were thinking about when we were writing these articles. So I'm going to go down here this time to the actual newsletter, and this will be this post will show up on the blog post in your email, and also you'll have links to it on our webpage. So here we go. And this newsletter, actually, thanks to our producer, this newsletter and editor actually flows pretty well. So we're going to flow right through it and not have to jump around. The main market-related article, we've talked about this before, is the capital markets and earnings. And we've got interest rates, we've got bonds, and an inverted yield curve update. As I flow through this, I'm going to ask you also to remember this deductibles and the emergency fund. But the main thing we're going to go to right here, and this is spoke about heavily in the newsletter, and this article, for those of you that are listening, is a multiple page article, and this is the graph that I'm looking at is from FactSet, and what it really shows is one of the best graphs I've seen. I saw it last quarter, and it just shows that the markets eventually do follow earnings, and we've had a year this year where earnings have been outstanding, and the markets are not yawning, but they're not doing near as good. That sometimes happens. Patience, grasshopper, as they say, patience. Another thing I've talked about multiple times now, and that is the inverted relationship to bonds and interest rates. As interest rates rise, bonds can have a headwind. And what will happen is eventually this evens out. The Fed will not raise rates forever. And so eventually these headwinds will become tailwinds as this graph shows, in the form of higher yields. So how far up can we go before interest rates may create a problem? According to JP Morgan in this neat little chart, now this looks back, it's about 5%. And I've wrote about it several times, and I think it's probably closer to 4 now. We're at 2. We got a long way to go. Based on, that would be another 2 years. That doesn't mean the economy can't go into a soft spot and we can't go into a recession, but it's likely that interest rates are far from creating that problem at this time. And inverted yield curve update. So the inverted yield curve has been a very good predictor of the next recession. And so the inverted yield curve, if we look at this area over here, when this crosses, as it did here, recession came. This is for those of you that are listening, this is the St. Louis Fred 90-day to 10-year spread. Fancy term to just mean short-term rates versus long-term rates. And when short-term rates go above long-term rates, as they did here, that's what happened. Then we had a recession. As they did, they had a recession. As they did, they had a recession. Pretty good predictor. So we're keeping an eye on this. One thing that concerns us, when we wrote about it in the cover letter to our latest quarterly report, was that a lot of people are talking about it now. For those of you that are listening, that we'll show you what that was. I'm doing this at my house, and that was our dog Chaka that just ran by. So you get an extra special treat here. It's hard to keep everybody quiet. All right, financial planning article, higher deductibles on policies. The world we live in now, especially in the insurance arena, all carriers are wanting us to take on more responsibility. And so as more responsibility, if we have higher deductible, the smaller things will be more of our responsibility, and longer term, that can be a big benefit. There are extreme cases. So those of you that are just watching the video, I'm scrolling through the detailed article about that. The next article is a personal liability umbrella policy, and that is really just it's major medical policy for liability. I've talked about it before in a couple of other videos and posts. I'm going to scroll on down. We're going to get to the emergency fund. This is a biggie and an important one. We've actually talked about this one before. The emergency fund is 3 to 6 to maybe more liquid funds available for you in a state of an emergency. And with the skies falling, these funds need to be available, so they're not risky investments. Make them work hard, but they do not go in the capital markets. They go in something that's super, super safe. All right, we're down to our app of the quarter. We've talked about this a little bit, and we love the Firestick. We've put these in our office. I put them at home, The neat part about these things is they're very reasonable. You can cherry pick what you want. And by the way, Firestick's not the only thing. There's Google Chrome, there's Firestick, and there's Roku. There's multiple different types of services. But we go into talk about it again. This is real, maybe a blooper video, but that's the dog barking at somebody else's dog. The multiple different things that you can do with the Firestick. Those of you that have been watching me for a while know that I travel with my 13-year-old tennis player, and after a long day of tennis, it's nice to just plug that Firestick in, and she pretty much gets what she would hear, and so she can watch her Grey's Anatomy or whatever she would like, and we can see some sports channels and stuff. All right, parting thoughts. We've got Columbus Day, and most importantly, not most importantly, but very importantly, we've got our holiday party. If those of you that are looking over here on November, the bottom right-hand portion, November 17th, DAC from 3 to 5, and that is our holiday party. We'll talk about it in more detail in the future. But right now, we're going to wind this thing down. I'm going to thank you in advance, and we will hope to get it all together. We still have new equipment. Thank you so much. Have a great day.